I'm Osborne Foreman, and in this week's portfolio update I'm going to show you the UK stocks I bought, as well as the performance in the last 11 months of stock picking. I know it's a little bit early, I will be doing a full review in April 2021. I'm also going to talk about my top risers and fallers, and if you find the video or if you like the video, please drop one of these to support the channel. According to Google Finance, the FTSE 100 is down 0.78%, the FTSE 250 is down 0.40%, and the S&P 500 is also down 0.75%. My portfolio has actually managed to outperform this week, breaking the longer than a 1 month long streak of consistently underperform the markets, and I've returned a nice measly 1.72%. Two words that don't necessarily go together, and it was off the top of my head. I suspect this is because a majority of my portfolio is weighted towards consumer discretionary. The likes of Boohoo, which sells cheap clothing, Games Workshop, which sells miniature figurines in a hobbyist sort of consumer base, and also the likes of Team 17, which sells a diverse catalogue of different indie games. This means I'm likely going to be very exposed to the cycles in the stock market, as well as the economic cycles. And I'm happy with this, as that potentially provides lots of opportunities to top up on potential high volatility dips, which means as long as I've got the risk tolerance together, I'm able to withstand the dips, and I have the capital available to buy more. It seems advantageous to be invested in this type of stock, and it allows me to continue building my positions over that longer term period. And maybe more predictably, these stocks are the types of candidates to fall by a significant margin in a market crash. So once more, I could take advantage of these dips and really bolster the portfolio's performance. I have little to no need for defensive investments or less volatile stocks in my portfolio at my current age. And this doesn't mean that defensive stocks are necessarily a bad investment, just that I don't think that they fit well with my aims. But based on risk tolerance, I see more disadvantages for myself than advantages. Although I found defensive stocks very useful for storing value, I'm someone that when investing sees cash in my portfolio and I'm immediately thinking, right, what stock can I buy? I'm interested. So it's kind of a good thing but a bad thing. It means that if I'm depositing money on a frequent basis, I'm frequently building my positions. However, if I wanted to store cash so that I could capitalize on a market dip, it's likely not going to be existent, or it's at least not going to be in my investment portfolio, but rather sitting in a high interest savings account. But what this does mean is that if I force myself to invest in a more defensive stock, which I've done further in the past with the likes of Unilever or Diageo, and what I could do is I could put the money into these positions, and then when the market crashes, or there's a correction for instance, these defensive stocks, they might drop by 1 to 5%. The more high volatility stocks could drop well beyond 10%, so I would sell out of these defensive stocks and buy into the lower, more volatile stocks, which I feel that I could take advantage at my current age of 21, with an investment horizon of potentially the rest of my life, and average lifespans being 78 years, that's off the top of my head. That is a potential 57 more years of investing. This, however, could certainly impact my performance if I'm therefore regularly trading my positions and selling out of the more defensive stocks. And it certainly could impact it for better or for worse. But because it is my first year of stock picking, I feel that it's advantageous to try out these strategies and then formulate my own strategy for the future, so that over the longer term I may be more prepared and more likely to reach my goals. For instance, it's unrealistic to expect a consistent CAGR, or compound annual growth rate, of 20% per year. I mean, even the professionals struggle to do it, but that might be a personal target you had in mind. There's no way that I could expect that consistently I would get this each year without a lot of work and dedication. This means that in the first few years I may continue to underperform, and that may mean that it would have been better to have bought an index fund. But I do not wish to do that. I wish to practice, get better, and hopefully see some visible improvements. If we look at my not so fancy spreadsheet, we can see that my growth returns, or simple growth returns, of the portfolio are 19.51%, or 20.33% with dividends added on top. And this seems to show that I'm underperforming a majority of the indexes that I'm benchmarked to. Sure, I'm outperforming the FTSE 100, but so are most other indexes in the world. The likes of the FTSE 250, I'm well behind. I won't even mention the Nasdaq or the AIM 100, for example. Although this isn't an accurate measure, and this is due to my technical inabilities perhaps, or perhaps more complications that will come down the line. And that's the idea, is that I can't completely track my portfolio. I have a simple return. Sure, if I had bought all of these stocks on the first day of investing with all of the money I have in my portfolio at that point, then the returns would be more accurate against the indexes, because these indexes are tracked from the first day I started investing. That's not the case though, and in fact on the first day I started investing, I bought a few stocks that I was perhaps unsure about but tried my best. I think I bought the likes of Redrow, Aviva and Shell. These aren't necessarily bad stocks per se, but they weren't perhaps fitting in with the type of investments or my investment thesis that I currently have. And I don't think it's unreasonable for some investors to put a lump sum into their portfolio and leave it for a year, for instance with ISAs and their tax allowances of £20,000. In my situation, this is near impossible. I'm weekly paid. I'm not going to save this money in cash. Why would I wait longer? Rather, it would be better that I just invest a majority of my paycheck each and every time and put that into the portfolio. This means that since I'm paid weekly, there's going to be lots of regular transactions. This also means if I wanted to track the complete and accurate performance of my portfolio, I would then have to write down hundreds, maybe even thousands of different transactions into a spreadsheet or a piece of advanced software. But then what makes it more difficult is I would have to compare it to the indexes with a similarly weighted return, which I think is quite unreasonable at this state. If I, for instance, did buy all of my positions when I first started and didn't top up again, then perhaps this would be a fairer way of tracking performance. But I feel, at least in my case, it's become a lot more difficult. I have tried getting a CSV from Freetrade, which is my stockbroker, by the way, and the formatting of putting it into specific apps just hasn't worked for me, and I still don't have those Google Sheets or Excel skills just yet. At least for a while, I think it's going to create the illusion that I am underperforming. That may be true, but I think it's going to create a more larger illusion of myself underperforming. I hope that over the longer term, as I put more money in the portfolio and as my regular deposits therefore impact the daily movements of my portfolio less, that's when I would hope that things would start to improve and I would start to catch back up to these respective indexes. You could also mention that, as I've just said, I use the Freetrade UK app. They track your performance. Why aren't you using that? And I found it very limiting, and that's because Freetrade is still in early developments. There's still so much more to come, and such we can't really expect too much of it when in 2-3 years more time this could be much more advanced. However, for the time being, as I've said, I have found it limiting. If we look at the time weighted return versus the FTSE All World ETF, we can see that already at the start of the graph, for the period of March in which I couldn't put money into my ISA, it already started tracking performance. That already had given it a head start. Then when I'd put my first deposit of around £100 in my first week into that portfolio, it immediately dropped down, because on April 7th, it was one of the largest gaining days in the market, which also adds to the reasonings behind how inflated my returns are versus these indexes. And at that time, I certainly did not have the capital available. For example, a majority of my money was deposited after July, at which point the markets had recovered a fair significant portion, especially in the US, which I believe were at all-time high. And you may believe that my free share referrals, such as if you sign up to Freetrade using my link in the description down below, you can get a free share worth up to £200. You may believe that these are perhaps inflating my returns, but this is not the case, as free shares aren't rewarded into an ISA account, only a general investment account. The top riser in the portfolio this week was Boohoo, gaining 4.61% and making a stride in reversing out of this last correction. I strongly believe that they are undervalued, although I think this is understandable, as for instance their multiples or their price to earnings multiples on their valuation may be impacted as the likes of the ESG funds, ethical, social and governance funds, are likely no longer invested. They had sold out after the initial claims of governance issues with Boohoo back in July 2020, and such is understandable as to why we haven't seen all-time highs since that period. I believe this will take a lot more time to continue, and even though over the last 9 months performance has been very much negligible, I think this could continue for at least the next 9 months. This will take time for people to rebuild confidence in this company, and it's going to require a lot of effort and energy behind the board members of Boohoo to really promote them as a sustainable business and make them appealing again to these ESG funds. As I said before, I would be interested in topping up my position if it gets close to my average share price of £2.49 per share. Although I do not want to top up prior to this, as I don't want to increase my systematic risk in my portfolio, as it is a very large position. Instead, I would rather put that money into my other stocks, diversify the portfolio more evenly so that my returns in the future may be more balanced. Although I must be thankful for Boohoo this week, as they have certainly dragged my portfolio upwards. I still hold 2,500 shares, and it's still the largest position in my portfolio by a large margin. And it will likely remain to be so for the next quarter of the year, in which I hope after that point I may have balanced my portfolio further, not by selling Boohoo, but rather by putting more money into my other stocks. Team 17 was another top riser, gaining 1.22% this week. Although in the grand scheme of things, they are still down 13% since I initially opened my position in early January 2021. That's 2 months ago. Their valuation looks much more attractive as growth stocks are continued to be squeezed and retail investors pour their money into these recovery stocks. I was asked why in a YouTube comment, and I apologize as I cannot find it now. I was asked as to why I continue to buy Team 17 despite their valuation being much higher compared to the broader market. And unless I know what's going to happen or what they're going to make in their pipeline, or they're going to 4 times their revenue in the next year, they can't see short-term returns coming from the investment. My response is that valuation is of a lesser concern to me. I am not too bothered about the overall valuation of a stock, the premium you may pay for it, because I believe that over the longer term, providing they're able to maintain a similar valuation to what they have now, that this will increase as they grow their earnings. Such, I would like to continue building a position in Team 17. And even if it takes 5 years, even if it's stagnant for 5 years until its valuation reaches a fairer level, I would be happy to continue buying, as it means I could build up significant equity in the position, and providing they have good prospects for the future, I believe this would fuel returns in my portfolio over that longer term period. So I'm going to continue buying shares of TM17, and this week I bought an additional 17. In fact, if you'd like live updates on my portfolio activity, buys and sells, as well as the cost basis, I've actually got a link to my Patreon in the description down below, which you can see a multitude of benefits, such as my stock watch list, their respective reasons to buy, and my personal price targets for these stocks, as well as stock write-ups on companies I am interested in. So once more, if you're interested in seeing my Patreon, click that link in the description down below. Ashtead Group, refusing to lose any value over the last 9 months, has climbed another 0.8% this week, which gives me reason to believe that people are still pouring money into the value recovery stocks. And that's fine, because I'm quite a contrarian investor, and such, when I see this happen, I'm likely to do the opposite. I'm not going to sell any more shares of Ashtead Group. I believe they're a very quality company, but at the moment I'm going to wait. I'm going to wait until cycles change. This could take years for all I know, in which the favour returns to the growth stocks. They see perhaps higher valuations overall, and then I would like to put more money into the value stocks such as Ashtead Group. However, for now, I'm going to let my winners run, but I'm also going to invest into the beaten up growth stocks, so hopefully I can fuel my portfolio's performance over that longer term period. As for Halma, they've continued to understandably struggle in the recent growth correction, and they've dropped by 2.65% this week, as they are a very high quality company that maintains a very high valuation with it. My mindset with Halma is that they're arguably much safer relative to the rest of the positions in my portfolio, as they have consistent revenue and earnings growth, and they're much more mature and diverse than a lot of my other holdings. However, for growth potential, I feel that they have a market cap of around £8.5 billion, And if we do look at the valuation, their price to earnings ratio is 48 times. Whereas I could see perhaps more apparent value in a growth stock like Team 17, which is a market cap of around £970 million, nearly 9 times less, and also has a lower price to earnings ratio of only 43 times. Obviously, this really depends on risk, and arguably Team 17 at any point in time could suddenly just go, crash, perhaps not grow their revenue as well, and there's a lot of money in the investment lost. Although I'm confident on Team 17's ability to continue growing and their high quality management, and thus I continue to buy such stocks. And this is why, in order to fuel purchases of Team 17 and other stocks, I have continued to sell Halma, and I sold 9 shares this week. Now I only hold 36 in total shares of Halma in my portfolio. I funneled this money into the heavily beaten up and top faller in my portfolio, Games Workshop, as shares dropped a further 3.47% this week. It shouldn't be much of a surprise to the regular viewers that I'm putting more money into this stock, as this is my highest conviction stock in my entire portfolio for the longer term, and thus it would seem reasonable to have it as my largest position. It's just back in the time, or back a few months ago, sorry, like even more than half a year ago at this point, the likes of Boohoo had a lot more apparent value to it, and thus I bought more of it. Perhaps I'm becoming more biased on the topic as I'm slowly learning more about the universe of Warhammer Fantasy, following the likes of the video games, or likely where they generate their royalties through Vermintide 2, and also the likes of Total War Warhammer. Although I feel that if I'm able to see the benefits of the hobby from a potential outsider, that this could be more appealing to newer players, and thus another investment case for Games Workshop. I'd also like to go speak to an employee at a Games Workshop store, like once the lockdowns are over, as I think it could be quite interesting to hear about the regular consumer base and how they've been dealing over this tough time. And it would be like a little mini audit, and perhaps that's a good video idea, although I would have to get permission first, obviously. I bought an additional 3 shares of GAW this week, adding my total position size to 67 shares, and I'm likely to continue buying next week if shares remain to be down, or at least very close to my average share price, which they currently are. Argo Blockchain is one that I've been quiet about as of late, and they've dropped by 2.74% this week, which I feel that in the grand scheme of things, considering their high volatility over the last few months, this is really absolutely nothing. I am not concerned about any drops, any falls. I'm still waiting on them to list on the Nasdaq, in an idea that I'm buying the rumour and selling the news. Obviously, this is a trading strategy, and I'm doing this to free up more capital in my portfolio to then buy more longer term stocks. Thus, I'm hoping to take a lot of profits once they list in the Nasdaq, or next time we may see a major swing, and then leave a small, perhaps 2 to 5% exposure to cryptocurrencies, so that I have that diversification inside my stock market portfolio. If I'm wrong and lose my entire investment, it only makes up a smaller portion of the portfolio, and thus it isn't a big concern to me, as it may take a few months to just rebuild that amount I've lost. Obviously, no losses are a good thing, perhaps good as a learning experience, but not for the capital growth of a portfolio. But I value that time and the likes of learning something important from it, and thus this money may be at a higher risk than the rest of my portfolio. I still hold 747 shares in my Freetrade ISA and 1,068 shares in my Trading 212 general investment account. If you're interested in seeing my bank statements revealed and how I'm able to invest a majority of my paycheck despite working in a pub, click the card at the top right of the video. Thank you for watching. Have a fantastic Sunday afternoon.